Welcome to the deep dive. Today we are going completely tactical.
Right.
We're stepping off the main street of market headlines and heading straight into the analytical framework used by the most senior portfolio managers.
That's our mission today. We want to dissect the market action, specifically around the close of Wednesday, November 26, 2025.
And this isn't about what the price did, is it? It's about something deeper.
It's about the microstructure. It's about figuring out the institutional intent beneath the tape.
I find this fascinating because, for most people, the final hour is just noise.
For the big players, it's often the most telling time. Our goal here is to give you a shortcut into that institutional thought process. We're moving past simple moving averages.
So we're looking for those robust, high-conviction signals.
Exactly. True accumulation or distribution. We need to look at the interplay of liquidity, volatility, and, those shifting correlations that pros use to assess risk.
Especially when the overall sentiment feels kind of neutral.
That's when it's most important.
Okay, let's unpack this. How do the biggest players read the market tape in that final hour?
We begin right there with the anatomy of the close. Usually you're looking at 1-minute or 5-minute bar data for the major indices.
And it all starts with price and volume.
Always. The core institutional analysis starts with that price-volume relationship. We're trying to gauge conviction. Is this flow just position squaring, or is this meaningful capital on the move?
Okay, so if I'm looking for high-conviction institutional accumulation, the biggest buyers making their move, what is the clear signature? Help me visualize that buy signal.
It has a very distinct look. First, you'll see strong volume on the up moves. That means institutions are aggressively absorbing any offers.
Okay.
But more critically, you are looking for confirmation. So if a key resistance level breaks, you expect to see a volume spike.
That's the conviction you were talking about.
That's the conviction confirming the breakout. And the defining signature right near the bell is what we call a visible lift.
A lift. Is that just a sustained rally, or is there something more to it?
It's the intensity. It's the intensity that really defines it. It means prices are trending steadily upwards into the close on consistent or even increasing volume.
So it's not a quick spike.
Not at all. It tells you the buying interest is firm, it's pervasive, and it's holding strong right until the final seconds. They sustain the bid.
And the reverse, the high conviction selling.
That's the fade. You see prices trending steadily downwards, again on persistent volume, if a key support level breaks.
You see that correlating volume spike.
You've got it. That confirms institutional sellers are aggressively hitting the bids. If you just see a market drift on low volume, that's ambiguity.
Lack of conviction?
Right. Could be passive rebalancing. We largely ignore that for conviction signals.
Okay, that sets the stage for price action. Let's layer in the fear gauge. Volatility. The sources emphasize that just looking at the VIX level is only half the story.
It's not even half the story. The term structure is the critical signal that institutions are analyzing.
Of course, the standard signals are VIX up, SPX down. That's fear.
VIX down, SPX up is complacency. But the structural relationship between the spot VIX and its futures tells us what the market expects for future fear.
We hear these terms all the time, Contango and Backwardation. Let's really nail them down.
Sure. Contango is the normal state of affairs. Long-term volatility futures are priced higher than the near-term spot price. It suggests a generally calm market.
So no immediate shock expected.
Exactly. The real red flag is backwardation.
And what does that mean in practical terms for a senior portfolio manager watching the close?
It means the near-term volatility futures, the contracts expiring in the next week or month, are priced higher than the spot price.
Wow.
This is a powerful signal. It tells us that institutions are paying an extreme premium for immediate protection. They fear a shock in the next few weeks, more than 6 months out.
So if that term structure flattens or, God forbid, inverts into backwardation near the close,
that is the strongest signal of immediate institutional concern you can get.
It's not just that volatility is high. It's that the market is willing to pay more for insurance right now. That's a key piece of information.
Absolutely.
Okay, moving into internal market health. Let's talk about breadth, because headline indices can be so deceiving.
They really can. One of the biggest strategic concerns earlier this fall was extreme market narrowness.
Right.
I mean, remember the data from October 28? The S&P 500 might have had an up day, but only 104 stocks advanced versus nearly 400 declining.
The index was just being driven by 5 or 6 mega cap names.
Which creates massive fragility.
Yeah.
If those 5 stocks cough, the whole market gets pneumonia.
But the sources suggest there's been a positive shift, an emerging broadening, right?
That's the most encouraging internal indicator we've seen. The November 25 data showed a really strong pivot. 2,729 advancing stocks against 1,707 declining.
And that's crossed the broader market.
Exactly. And look where the leadership is coming from, mid-cap and small-cap stocks. Their advanced decline ratios were 1.31 and 1.59 respectively.
That kind of magnitude suggests real capital rotation.
It does. Money is leaving those concentrated winners and spreading out, which is a sign of much healthier risk-taking.
Okay, that makes the shift feel more sustainable. Now, if the broader market is getting healthier, where are the biggest players actually putting their money? We've got specific dark pool signatures.
The dark pool flow confirms that the positioning is massive and targeted. On November 25, SPY recorded over $5.63 billion in inflow.
All in huge blocks, away from public view.
Right, and we saw continued substantial dark pool activity in the usual suspects, NVIDIA, Microsoft, Alphabet, but also, importantly, in LQD, the corporate bond ETF. They're committing capital, but tactically.
What about that bifurcation strategy? They aren't just buying everything.
Correct. We saw this developing back around September. Institutions were maintaining a negative gamma tilt or actively hedging on the major indices like SPY and QQQ.
So buying cheap protection on the indexes.
While at the same time, they were engaging in aggressive buying in select small and mid caps.
It's the ultimate risk-on but hedged position. They're hedging macro risk while accumulating individual rotation plays.
That's it.
Let's circle back to the VIX with those specific numbers from November 20, because the term structure really reflects this cautious accumulation.
It showed a mixed structure. Spot VIX was at 26.42, which was significantly higher than the December future at 21.4.
So that gap is short-term backwardation.
Exactly. The market is pricing in that the immediate current spike in volatility is transient. But further out, the curve was in long-term contango. January and March futures were still priced pretty high.
They think the fire will die down quickly, but they still expect to live in a highly volatile neighborhood long term.
That's a perfect way to put it. It speaks to underlying structural concerns.
Which brings us to part 3, structural risks. And this is where things get, well, truly precarious, starting with this liquidity illusion.
This concept is so critical. We keep hearing about $7 trillion sitting in money market funds.
Right, the massive cash on the sidelines narrative.
And it's presented as this dry powder waiting to fuel the next rally. But that's the illusion.
Why? Why is it an illusion?
Because that's parked liquidity. When that money is deployed, when MMFs buy assets, it fundamentally drains system liquidity. They are taking high-quality collateral like treasuries out of circulation to fund the purchase.
So it's not fresh capital, it's a rearrangement of existing collateral.
Exactly. It effectively tightens the money supply available for trading and hedging. It's an illusion of safety, not a pool of available risk capital.
So if the market needs liquidity, MMFs are actually part of the problem, not the solution.
That's the paradox. And it's coupled with a massive ticking time bomb sitting right on the balance sheets of U.S. banks.
And this is the detail that gets overlooked.
It does. U.S. banks reported a staggering $395 billion in unrealized losses on their securities portfolios as of Q2 2025.
A latent risk just sitting there.
And if a liquidity event forces banks to sell those long-duration holdings, if they have to realize those losses, it could trigger a severe crisis of confidence, a sudden credit tightening.
Wait, but $395 billion, while huge, is that really unmanageable relative to total assets? And why is the market still stressed by Q2 data now, months later?
Because the underlying cause, the rise in rates hitting long-dated bond prices, hasn't been fixed. Those losses are sticky.
Okay.
And while structural liquidity in the repo market is technically better than it was in 2019.
Because of the new facilities.
Right. But the banks themselves have become the marginal supplier of repo funding. They're what we call inelastic providers.
Inelastic?
Right.
What does that mean for the average borrower?
It means they require much larger changes in short-term rates to be motivated to extend funding. They aren't going to jump in and solve a liquidity crunch unless the price is significantly higher.
So the framework is better, but the core supplier, the banks with those unrealized losses, is more fragile.
And less responsive. That's the key.
That liquidity paradox brings us to the biggest strategic shift facing every portfolio manager. The failure of the 60/40 portfolio.
It is broken down structurally. The traditional hedge relied on bonds rallying when stocks fell. The reliable inverse correlation.
And that just stopped working due to persistent inflation and huge fiscal imbalances.
Hmm.
We saw periods where stocks sold off and bonds sold off at the same time.
Your diversification just vanished.
It's gone.
So institutions need new hedges?
Yeah.
Where is the smart money going?
They're rotating. Gold has stepped in, showing a much healthier positive correlation with treasury yields during sovereign stress. It's acting like a superior safe haven in this new regime.
So we're seeing actual strategic shifts being recommended.
We are. Morgan Stanley is suggesting a move toward a 6-0-20-20 allocation, equities, fixed income, and a dedicated precious metals component.
And you can see this nervousness directly in the fixed income flows.
Absolutely.
Yep.
The flight from duration risk is stark. We've seen significant outflows, $5.6 billion from long-term U.S. Treasury ETFs since last November.
But the counterflow is what's really staggering.
It is. Substantial inflows of $68 billion into short-term U.S. Treasury ETFs. Investors want income and safety, and they are refusing to commit to the long end of the curve. That's a huge commitment to short-term safety. Now let's pivot from those immense structural risks to the micro level, the hunt for gamma.
Right. Asymmetric setups for tomorrow's trading. For an institutional desk, this means identifying liquidity pockets.
So, areas with high trading activity and significant open interest in the options market.
That's where they could execute large block orders with minimal slippage.
But those pockets can be deceptive, can't they? If a large order hits and the depth is shallow, what happens?
It's like trying to fill a bucket with a fire hose. The market can't absorb the size, and you get rapid price discovery. Volatility spikes. Movement accelerates.
And the force behind those flashpoints is gamma.
Yes. Most people know delta, but gamma is the real engine of volatility.
So can you just define that for us clearly?
Gamma measures how quickly an option's delta changes as the underlying asset price moves. In layman's terms, it defines the necessary adjustment for dealers trying to stay delta neutral.
To keep their exposure flat.
Exactly.
And this leads us to the famous gamma walls. How do those work?
Gamma walls are just key strikes, usually round numbers, with vast open interest in options. Market makers are typically short these options, meaning they have a lot of negative gamma.
Okay.
To hedge this, they are forced to buy the underlying as it rises and sell as it falls. This reactive hedging creates a self-fulfilling prophecy.
A gravitational pull on the price.
It's a powerful magnet, causing the price to stabilize around that key level.
That keeps things calm. But the whole point of hunting gamma is the asymmetry when that wall breaks. Tell us about the gamma flip. This is where it gets really interesting.
The gamma flip is the moment the market moves decisively past one of these major walls, especially on low liquidity. When that happens, the dealer hedging behavior reverses instantly.
They're forced to rapidly rehedge.
And their stabilizing behavior suddenly turns into an accelerant.
Wow.
They become forced sellers when the market falls and forced buyers when it rises. This creates a powerful, self-reinforcing move that accelerates the price.
And that's your asymmetric opportunity.
That's it. A small price catalyst triggers a large volatile response because the derivatives market is amplifying the move. A shift into deep negative gamma territory is a huge warning sign.
Okay, we've covered the close, the internal rotation, the structural risks, and the micro-level options dynamics. What's the single most important takeaway for our listener right now?
It's recognizing the duality of this market. The recent broadening small and mid-cap participation is a short-term tactical positive. It reduces that concentration risk.
So that's the good news.
That's the good news. But this optimism is operating against a backdrop of fundamental, long-term structural vulnerabilities. The liquidity illusion, the unrealized bank losses, the breakdown of 60-40, it all demands agility.
That sounds like a market where you have to be right twice. Once on direction and once on timing.
Absolutely.
We'll leave you with this final provocative thought. Think about the $68 billion institutions are pouring into short-duration fixed income. That's their safe haven trade. At the same time, U.S. banks are sitting on $395 billion in unrealized losses on their longer duration portfolios. If a major liquidity event forces those banks to realize those losses, triggering systemic stress, what happens to the value and liquidity of that short duration paper that everyone now considers the absolute safe haven?
That is the question. This is not a market for complacency. It is a market demanding deep scrutiny of second and third order effects.